welcome back to the Digital Ledger Podcast. I'm DJ, joined by Jeremy, who keeps us honest when it comes to the numbers. Today we're getting into IFRS 18 and what it means for how companies actually report income statements moving forward.
You know, DJ, this is one of those changes that sounds procedural on the surface, but is really forcing a fundamental shift in how finance leaders think about transparency and comparability.
Yeah, and here's the thing. For years, the income statement was essentially the Wild West of financial reporting. Under the old IAS 1 framework, there wasn't a clear, enforceable definition of what operating profit even meant. Companies had massive latitude in how they structured those numbers.
That's exactly right. You could have two companies in a same industry, similar performance, but their income statements would tell two completely different stories about operational health, and both were technically compliant. It made apples to apples comparisons nearly impossible for investors and analysts trying to get a real read on core business performance.
So the problem wasn't cosmetic. It created genuine barriers to understanding what was actually happening inside a business. And that's where IFRS 18 steps in. This isn't the minor adjustment. It's a complete restructuring of how companies arrive at that final profit number. It imposes discipline and transparency that was largely missing before.
Right, and the first big shift is the new five-category taxonomy. Every single income and expense item now has to fit into one of these buckets: operating, investing, financing, income taxes, or discontinued operations. This isn't just about tidiness. It forces a clear separation and stops companies from easily moving unusual and volatile items out of what's considered core business performance.
So no more bearing the less flattering numbers in a vague other line or shifting things around to make the core business look stronger than it is. That's a real increase in discipline. And then there are the mandatory subtotals too, right?
Exactly. IFRS 18 introduces three non-negotiable subtotals that have to appear on every income statement: operating profit or loss before financing and income taxes, and then your final net result. These act as standardized anchors. For finance leaders, this means metrics like return on capital employed or interest coverage will finally have consistent inputs across companies. It removes the ability to polish your own versions of EBIT or create customized metrics that don't hold up under scrutiny.
Before we continue with the episode, we want to be transparent with our audience, and that is that AI helps support research and shape parts of this episode. But all fact-checking, analysis, and final decisions come from us as humans. We're blending the best of both worlds. Okay, picking up where we left off. Even with all the standardization, IFRS 18 does have a critical nuance: the main business activity exception.
Right. For example, banks or real estate companies where interest or rental income is central to operations can classify those as operating. It acknowledges different core business models, but it's not a free pass.
And the critical part here is that this decision requires real, verifiable evidence, not just management preference. It can't be a convenient way to move an unusual item out of core operating results just to polish performance. It has to reflect genuine business activity.
That's where the discipline comes in. The assessment happens at the company level and demands tangible proof of what the main business truly entails. It offers necessary flexibility where justified, but it closes off those older, less transparent loopholes.
All right, let's talk about management-defined performance metrics, what most of us know as non-GAAP metrics. IFRS 18 is now pulling these directly into audited financial statements.
This is a game changer, DJ. These measures are no longer supplementary. Companies must now provide specific notes detailing the MPM's usefulness, a clear reconciliation to the closest IFRS number, and explicit statements confirming they reflect management's view, including tax and non-controlling interest effects. This is full accountability.
That's where the increased accountability for boards and audit committees comes in. It professionalizes the non-GAAP narrative. It means reducing investor skepticism and making it much harder to selectively remove what might be considered bad costs, while conveniently keeping favorable items in your reported performance.
Absolutely. The old flexibility is gone. This bridges the gap between IFRS numbers and investor communications, demanding real rigor and auditable processes for how these metrics are defined, calculated, and presented. It's about earning and maintaining trust through transparency.
So, for finance leaders listening, here's the move. Review every non-GAAP metric you currently use. Make sure each has a crystal clear definition, an auditable reconciliation path to IFRS, and a strong justification for its usefulness. This isn't just disclosure, it elevates the integrity of your entire financial story.
And it's not just the big picture metrics, DJ. IFRS 18 also takes direct aim at those vague other lines that have been in financial statements for years. You know, other operating expenses or miscellaneous income. They've often been black holes where less flattering numbers go to hide.
Right. The standard effectively limits the use of those vague labels. Companies can no longer just lump material items into general categories. Every income and expense item must now be grouped or separated based on 6 specific factors.
Those factors cover the nature of the item, its function within the business, whether it's persistent or one-off, the measurement basis used, its size, and the timing of its impact. If something is significant enough for users to question, it has to be properly explained.
And there's also a new by function disclosure requirement, right?
Yes, even if you're reporting expenses by function, like cost of sales or administrative expenses, you now have to disclose the total amounts for 5 specific expense types in a separate note. Things like total depreciation, amortization, employee benefits, impairment losses, and inventory write-offs.
So even if you're presenting functionally, you still have to pull out those natural expense types simultaneously. That sounds like a significant data collection and system challenge.
It is. Finance teams need systems that can track expenses by function and by natural expense type at the same time. Relying on manual fixes or spreadsheet gymnastics at the end of a reporting period won't be sustainable or hold up under scrutiny. This demands robust data architecture now.
And the ripple effects don't stop at the income statement. This hits cash flow reporting too.
Absolutely. For anyone using the indirect method for cash flow statements, IFRS 18 mandates that it now must start with operating profit. That's a big change from the previous flexibility. And it goes further with interest and dividends. If they're paid, they're financing. If they're received, they're investing. This removes a lot of policy choice, meaning your systems need to be smart enough to differentiate between FX gains from operations versus those from financing.
That system impact is huge, and it brings us to the action plan for controllers and FP&A teams. The effective date is January 1st, 2027, but companies have to restate their 2026 numbers. That means preparation needs to start now. What are the immediate steps?
First, run an impact assessment. Identify your main business activity and define which of your current metrics will qualify as MPMs under the new rules. Then do a gap analysis. Can your existing systems even track the required details? Many teams will find they need a system and chart of accounts redesign to align with the 5 new categories. And finally, stakeholder communication is critical, particularly preparing the board and audit committee for their expanded responsibilities.
So if you're a CFO or controller listening, take your last quarterly report and ask yourself, which of our current metrics would qualify as MPMs? Can we reconcile them cleanly to IFRS? And do our systems allow us to track expenses both by function and by natural type, without manual workarounds? Those are the questions that will define how smooth this transition is.
And honestly, DJ, this isn't just a compliance exercise. It's a strategic opportunity to enhance transparency and rebuild trust with stakeholders who've been questioning the integrity of non-GAAP metrics for years.
Yeah, I think that's the real reframe here. This isn't something to survive, it's something to use.
Couldn't agree more. Really valuable conversation on this one.
I think that's a good place to leave this. It's been a really good discussion. And to everyone listening, thank you for staying with us and spending your time here. We don't take that lightly. Until next time.